All right, my friends. So in my video series on bonds and what you need to be looking out for, I had a comment. It's actually pretty good. A guy said he thought the guy who was talking about 5 to 7% investment graded bonds that he could get at discount, he thought he was probably talking about closed-end funds. And I said, that's actually a pretty good point. I want to talk about that because closed-end funds can sometimes be all the rage. And I'm just typically not a big fan of them, and I'm going to share with you why right now. So a closed-end fund, unlike an open-end fund, you send $1,000, you get $1,000 worth. They open up the number of shares, and unlimited shares on an open-end fund, which is why something like the Vanguard Index 500 can be so large because every deposit they get opens more funds. It's open-ended. There is no closed shares. There's no set amount of shares out there. The shares are literally infinite. It can be infinite. A closed-end fund is just like a stock. They issue a certain amount of shares and it's closed. So you're buying the stock, essentially, is what it would be, based on the number of shares outstanding. Sometimes the stock is going to trade at a premium. Sometimes it's going to trade at a discount relative to the net asset value, the holdings they have underneath there. And so I want to talk about that a little bit because it's interesting. A lot of people think buying a discount closed-end fund means they're snaking the system. They're buying something at deep value, which means it's only going to go up in value because there's upside opportunity. I want to talk about that. So let's look at John Hancock Investors Trust and through Morningstar, and I'll get into a reason why I got here first. Well, essentially, let's go back. I went to closedendfunds.com or CEF Connect, CEFconnect.com. I did a screener for corporate bond funds, all right, and I did a screener that were trading at discounts because I want to show you what it's talking about. So here, if we go to price, actually this is now was John Hancock, yeah, actually a trade. Hold on just a second, that's performance. I want to go to right here. All right, so right here we got a current. Is the share price is? Let me just make that bigger. 1548 is the share price. So if you bought one share, it costs you 1548. The stuff within the fund, though, in all total trades at 1731. So all the various bonds that this fund has in it doesn't trade at 1548. It trades at 1731. So you're getting a discount of 10% from the share price to the actual value of the fund of the bonds within there. And if you can see, if you look, you had a pretty significant discount for the last year. I mean, well over 10% over the last year from discount to price. Let's go 3 years. Same thing. 3 years. Look, we came right. The black is a discount. The light blue is a premium. Not the premium, the NAV. So in March of 2016, you're getting the fund. You could buy it about 15 and a quarter, it looks like, when the assets within the fund, and I'll explain this in just a second, we're trading at about 16 and a half. Significant discount right here in December 2018 is trading about $13.50, where the fund itself was worth $16. Let's go back and you can see that just right there, only in in September, looks like 2017, did it break the NAV and the price have equilibrium. But for the last 3 years, that's the only time. Let's go 5 years and see if we have any difference. And 5 years ago, in March 2014, it was trading at a significant premium to NAV. So why? I don't know. Let's take it since inception. And it's going to be tough to, it's going back to 1980, so it's going to be tough to see that graph. But you can see here, again, the NAV, the value of the assets within the fund are trading in the light blue, but the price sometimes way under, way over, way under, way overweighted. So there is some opportunity there potentially, but I'm going to share with you why you shouldn't pay much mind to that. So if you think about the share price and you think about the NAV, let's think about what is the only thing that matters to you as the owner of the fund. The only thing that matters is what someone is willing to pay you for it. That's how prices and value is determined. It doesn't matter what the NAV is. So think about your house. You got it appraised for $400,000. You're putting out the market and you're asking $400,000 for it. The only bids you get are for $350,000. What is the value of your home? Well, the home is not the appraised value. The value is the price someone is willing to pay. The appraiser said it's worth 400 and you're asking 400, but you're only getting bids for 350. You're either going to do one of two things. You're going to have to settle for 350 or you're going to have to keep it. That's all. I would keep your home. There's no other way around that because the value is not 400. The value is only what someone is willing to pay. That's actually the difference between socialism, which eliminates a pricing mechanism, and free markets. Is free markets have a pricing mechanism which says the value on this calculator is not what Texas Instruments charges, it's what Josh is willing to pay and millions of other people's in their individual transactions every day. That's how value is actually derived, is what someone is willing to pay. Nothing else matters. So when we're looking at NAV versus share price, we're saying the value is 10% discounted to the actual value of the account because the share price is only $15.48. It doesn't matter. It doesn't matter. The value is only what someone's willing to pay, not what the price is. I cannot stress that enough. Now, sometimes the value might be higher. The price might be higher than what what the actual value is. In this case, it was trading about $21, where the actual value is 20. So in that case, my house was appraised for $400,000. Someone's willing to pay $450 for it. What is the price of the home? It's $450. It doesn't matter what the appraised value is. It matters what someone is willing to hand over money to me for. All right, so don't get caught up in this price premiums to discounts. I mean, yes, there can be some arbitrage there. There can be some ability for you to potentially leverage, i.e., hey, I'm buying at a discount, you know what I'm saying? So I'm getting a better value added if the price ever changes. And we've seen on occasion that's happened. Let's see, going back, and I wish, we can make this wider. Let's see. Yeah, it still doesn't do much. I mean, that doesn't look like much, but there is some value there, potentially, if you're able to time it right, but you're not going to be able to, when no one knows. So just keep that in mind, that the price only matters what someone's willing to pay. But I hear that all the time. People say, I'm willing to pay, am I getting a 10% discount so I have capital appreciation? No, you don't. I mean, you could, but you don't. I mean, just no other way around that. And on top of that, I'm getting a 10% premium. Does that mean there's no potential for capital appreciation? No, because if someone's willing to pay a 15% premium, guess what? You got capital appreciation there too. All right, so now distribution rate is 6.35. So people are saying, look, I'm getting a 6.35% distribution rate on this. That's where I think this guy's making a mistake. He's saying I'm getting between 5 and 7% on bonds and I'm getting a discount. Look, I'm just assuming this is what this guy's talking about, but I'm going to tell you why that's not a big deal. 6.35 is the distribution rate on this fund. And so people are like, wow, that's pretty good. All right, but let's take a look at this here, shall we? Let's go to portfolio characteristics. All right, so what do we got here? We got Corporación Nacional del Cobre, Petróleos Mexicanos, Israeli Electric Corporation, Credit Agricole, Mexico City Airport. Let's see, Banco Pactual. I mean, I don't even know what all this stuff is. America Movil, Metro. I mean, so what is all that? No, that is foreign funds. In fact, if we go down here, they got 68% of the U.S., but even that is just U.S. dollar denominated. So it doesn't really matter that much. There's a lot of foreign stuff in here. So when I did a investment grade bonds, yeah, I think I did investment grade bonds. This came out, and on top of it, it showed as a discount, but there's a lot of foreign bonds in here. Now, they might be investment grade in the credit rating agencies, but it's still Corporación Nacional del Cobre. I don't even know what that is, but is that the same as U.S. Investment grade companies? I don't think so. Now, I want to show you something else here, too. This won't show me. No, this isn't showing me portfolio turnover. They got 257 holdings, so that's good. So it has a lot of different bonds in there. So it's not, I mean, that's very well diverse, which is what you want. And a lot of different sectors of the economy too, consumer discretionary, financials. All right, now let's look at performance. Now this is important here. All right, actually, I want to show you something. Let's see if it shows me right here. I want to go down here. And this is a very good chart, but this is going to be hard to see. Let me make this even bigger. All right, so here is the performance. 11.54% is the average annual rate of return that this guy has got price. We don't care about NAV. We just care about price because NAV, again, is the appraisal of the home. It doesn't matter. The only thing that matters is price, what someone is willing to pay. All right, so we got 11.54% annual rate of return. And this is where it gets, I'm going to show you why that's not, you got to look beyond that annual price. Or you got to look at beyond that. Discounted. All right, so you're thinking, wow, I got 11.54% on the last 10 years. So let's say you put $100,000 in there, right? And you got 11.54% is your annual rate of return you got for 10 years. How much should you have in there? You should have $298,000 in there. But that's not what you're going to get, because this is the difference between arithmetic report and compounding. I can't remember the two terminologies are in mathematics, but arithmetic and I think it's compounding. I'm drawing a blank. All right. Anyway, so let's go back. So here's our year-over-year returns. All right, so let's go back to the last 10 years. In 2009, it was up 55.9%. In of itself, that should right there tell you immediately this is not a typical investment grade bond fund. No bond funds investment grade are up 55.9. Junk bonds maybe, but nothing that we're trying to, not getting Boeing AA bonds here. 21.91, 21.72, 10.91. So pretty good from 2009 until 2012. Then down 10%, up 3.2, down 11%, up 25, up 13, down. So what if you do this year over year over year, what you're going to come up with is you're going to come up with, if you put $100,000 in 2009, it's worth $234,000 at the end of 2018, which is not an 11% rate of return. It's actually 8.9, which is still pretty good. I mean, don't get me wrong. That's still a pretty good rate of return. 10 years, 2009 to 2018 is an 8.9%. The difference between arithmetic and I think it's compounding rates of return. I'm drawing a blank. Geometric maybe. Maybe that's what it is. Geometric rate of return. Anyway, so they're showing the 10-year returns are 11.54. All right, well, that's not true. The 11-year returns are 8.9, all right, and that'd be simply because of the difference between compounding and arithmetic. Now, I want to show you something else, though. If we look back from 2008, 14.4, actually, this actually is showing from, I might be mistaken there because they are showing from 315 to 2019, the average rates of return. I don't think it's that much, but anyway, either way. But I want to show you, it sounds pretty good, except for you got a lot of down years in there for sure. Now, if you look at 2008, though, 14.4%, all right, until 2018, you lost 14.4, then you're up 50. I mean, then that return from 2008 to the end of 2018, $100,000 is worth, let's see if you can see that, $199,000. So over those 11 years, it's only 6.4%. Again, it's not bad. I'm not saying it's bad. You got negative, up, negative, up, negative, up, negative. I mean, that's not bad, man. I mean, it's not. But that's not investment grade bonds. That's the whole point. Yes, that's pretty good returns. This isn't corporate AA, single A investment grade corporate bonds. It's not. All right, so let's go. So we talked about a couple things here. A lot of international stuff. Lots of volatility. I mean, down 14%, up 55.4, down 10, up 20. I mean, that's stock-like. That's stock-like stuff. You can't get caught up in the thing in terms of, oh my goodness, it's trading at discounts to premiums. Now, I want to show you something else too. Let's see. I want to show you. So if it shows you this here, because this is interesting. Nope, they're not going to show you that category. Taxable income investment grade. All right, taxable income investment grade certainly is in not United States. It's just not. I mean, no other way around that. Expense ratios, 2.48% expense ratio. Whoa. Now, expense ratios like that are fine if we're getting stock-like return. That's not fine, but if we're getting stock-like returns, you can maybe justify that. You can't, but you're not paying 2.48 for a corporate bond that's yielding 4%. That'd be insanely dumb. Don't do that. But there's more to this. You ready? I don't think they're showing it here. Let's see. Yeah, they're not showing it. I'm going to show you it right here. Oh, they are showing it. Total percent portfolio effectively leveraged. You see that number right there? A third of the portfolio is leveraged. You ever heard of Bill Gross from the PIMCO Total Return Fund, and then he went to Janus and he's since retired? One of the reasons he was able to do so well in that fund was because of the amount of leverage he took. There's no two ways around that. Leverage is not your friend when it comes to stock market or investing. It's not. Leverage, I'm telling you, you're leveraging when you buy your home. So if you got a mortgage, that's enough leverage. Don't buy anything else with leverage. It will come back and bite you in the bud like you would not believe if you're not careful. That's the leverage right there. 37%, over a third of the portfolio is leveraged. So let me give you an example. On a $100,000 home, if you put 20% down, you are leveraged, what's that, 4 to 1, all right? If your equity increases by 20%, i.e. by 20,000 bucks, now you have $40,000 of equity. Well, you only put 20,000 in, so you have a 100% return on equity, ROE. That's wonderful. When it works. When it doesn't work, though, you still have $80,000 at stake. So if the market goes down 20%, now you have no equity. You're 100% leveraged, 100%. Leverage is great when things go up. It's horrible when things go down. I'm just telling you right now. So if you have a mortgage on your home and you're buying any kind of leveraged portfolio, I'm just telling you, don't do that. Especially when the best you got is you got $100,000 in 2009. It's worth $234,000 in 2018, costing you well above 1% a year, with a third of it being leveraged. It's just not worth it. No other way around. It's certainly not investment grade, typical corporate bonds. It's just not. It's just not, my friends. On top of that, the price versus the NAV is very alluring, very seductive. Look, I used to mess around with the Nuveen closed-end municipal bonds. I'm a fan of that kind of stuff. I'm not going to get you wrong. But I'm just telling you, for what we were trying to accomplish, which is a discussion on bonds that are out there, you're not getting anything above 5 to 7% or above 5% with any significant discount unless there's something going else on the scenario, which in this case is significant leverage, is significant fees, it's a significant discount to the net asset value, and nothing wrong with that. But this is not apples to apples comparison. So let's just look at the Morningstar thing we talked about. I don't think I showed you here. So Morningstar, again, we got 6-month average discount to premium, 3-month average discount to premium. We talked about that. Last average discount to premium, and that is why. So why for over 3 years has the average discount the premium been at 1.8%? So it's basically traded 1.8% below the NAV value, the appraised value. So the price has been 1.8% below the appraised value for 3 years. Over the last 6 months, it's 9.53, but now it's at 10.57, which is the most it's been in a while. What's going on there? Does that mean there's opportunity there? Maybe, but I mean, what you think? You're the only one out there who's like, oh man, I'm so much smarter than these other guys. What is going on? Why is it trading at such a discount to premium? That tells me a lot of people are selling it for some reason. They don't want anything to do with it. I mean, I don't know why. But if it's trading at that much of a discount to premium, it was basically trading on par. Now it's going down, down, down. And it's been going down more and more and more. That tells me something. I don't know what it tells me, but it says to me there's a lot of people selling, not that many people buying it because they don't like the idea of the holdings in the fund for some whatever reason. I don't know why. Let's look at Morningstar, and that's just discount to premium. We just talked about that. Let's look at some other stuff here. Let's talk about management fees. And here's something else that happened too. All right, so here's the expense ratio adjusted, 2.52%. But that wasn't always the expense on this fund. The expense on this fund was just recently 2.52%. So I'm not sure why. Let's see if I had it on here. That's that. Hold on a second. The expense ratio is 2.51, but it wasn't always like that. It's just a recent phenomenon where the expense ratio jumped up, and I don't see the I'm not seeing it on here where I showed it. I can't remember. But anyway, yeah, so look, the 10-year average premium discount was actually almost par. It was actually a little bit above, a little bit of a premium over discount. 5-year average 6.24 below on discount, and a 7-year date is 7.1. Why? Why is that happening? Don't know. Anyway, so there was a chart here someplace that showed historical expenses. I don't know where it's at. Let's see if it shows on here. Distributions, let's go to basically overview. No, not there. We'll go to fund basics, see if it shows that. Third party links, you're right here. Yeah, that's the, yeah, so they have interest expense of 1.39. I guess that's the leverage. That must be the leverage. So historical baseline expense 1.09, then they had interest expense of 1.39. I bet that's it, because that wasn't always like that. They showed a history of the expenses. I don't know where it's at off the top of my head. I remember looking at this before I did this video, and the historical expenses were about 1.25. So now all of a sudden it's doubled, and that's because of interest expense when they're basically buying, they're leveraging is what they're doing, and that must mean they're trying to juice the performance. They must not have leverage in the past. And I don't know. I frankly don't really care all that much, but it's interesting. Let's see. Yeah, I don't know. Anyway, so that's of interest to me for sure. Why suddenly is that expense ratio 2.5 when it used to be 1.24? Why suddenly is the NAV to significantly higher than the price and has gone more and more of a difference of a chasm? It's just growing more and more. Why is that? I don't know. It's interesting to me. No, look, am I saying you shouldn't buy this? No, I'm just saying at the end of the day, do what you got to do. It's up to you. But recognize it's multi-country. All right, it is investment grade bonds. So the bonds in there are investment grade, but it's not domestic. Lots of leverage, high expenses, low price to NAV, and then the performance numbers are. I'm telling you, 6.4% from 2008 to 2018. If you're going to invest in this, might as well just be in stocks. That's the way I see it. So be careful on I keep saying preferred closed ends. I would frankly, if you're going to be in something like this, just be in stocks. I don't know why you would. Finally, always remember, if it's too good to be true, it is. There's a reason for that. If the corporate bonds, the AA bonds are yielding 3.1, single A bonds are probably 3.25 to 3.5. Low investment grade bonds are probably 3.75 to 4. Why in heaven's name would anything give you 5, 6, or 7% investment grade at a discount? It just simply doesn't make sense. All right. Hope this helps. Don't forget to subscribe. I'd love to hear your comments down below. Have you ever experienced preferred closed-end funds? I'd like to hear about it. Put it in the show notes, and we'll see you next time. Thanks now.